Hello all, happy morning. Hope you are all doing good and the preparations are going in the fast-paced manner. And to support your preparations, we from the Array Academy has come up with this Super 30 series, wherein we have collated somewhere around 30 questions, which is important from the examination perspective and which will help you to boost the last minute revision. So we have taken variety of problems and we have tried to cover almost all types of problems, mostly what is being asked in examination. Those types of problems from each chapter, we have taken some 2 to 3 questions and we are solving it to get the last minute grip on the chapters, right? So before this video, we have uploaded 2 videos. First one is in relation to amendments. So we have in that video we have discussed the recent amendments, whatever is most importantly applicable for the current examination. That is the first video. And in the second video, we have uploaded the first answers to the first 5 questions of the Super 30 questions. Now let us go into the next 5 questions. So now let us look at the next 5 questions. So if you want the PDF of this specific Super 30 questions, you can message to this number. You will get a copy of this PDF of Super 30 question. Okay. So now let us get into the next 5 questions of Super 30. So now we are going to go to question number 5. Question number 5 is a salary based question. Question number 5. It is a salary based question. Okay. And this is in relation to salary old scheme. Salary old scheme of taxation. Old scheme of taxation. In respect to new scheme of taxation, we have already solved a question number 4. You can visit that video, which is the first part to Super 30 questions. You can visit and have a look at that video. Right? Now let us dwell into this question. So in this question, so Mr. Ratnam, who is an employee of a private sector company for previous year 24-25, we have to calculate the income from salaries. So we are not required to compute the total income. We are required to compute the income from salaries for our assessment year 25-26, assuming he has opted for the old tax regime. So he is under 115 BAC 6. He has opted for the old tax regime. Right. Now let us get into the question. So basic salary is 55,000 per month. Dearness allowance, 50% of which forms part of salary, is 20,000 per month. Entertainment allowance is 2,500 per month. Conveyance allowance, of which is 20,000 he spends for official purposes, is 3,000 per month. House rent allowance is 22,000 per month, and the actual rent which is paid for a house in Chennai is 25,000 per month. Children's education allowance for 3 children, rupees 500 per month per child. Medical allowance, for which he spends 15,000 for his medical treatment, is 3,000 per month. Mr. Ratnam contributes 12% of his salary to RPF, and his employer also contributes the same amount. Interest which is credited to the accumulated balance of PF is at 12% of salary, which is 36,000. Next, he is provided with a self-driven 1200cc car, which he uses for both official and private purpose. The car is owned by the employer, and all the expenses are borne by the employer. Professional tax at rupees 200 per month is paid by the employer. That's it. The question comes to an end. Now we have to compute income from salary for the specific employee. Now let us start the question. First is serial number, particulars, note number, next is amount in rupees, again amount in rupees. Okay. serial number, particulars, note number, amount in rupees, and amount in rupees. Okay, first is serial number 1. Serial number 1 is basic salary. Basic salary is rupees 55,000 per month. 55,000 per month. So this comes to 6,60,000. Okay. Next is point number 2 is dearness allowance. Dearness allowance. Dearness allowance is 20,000 per month. 20,000 per month. This is 2,40,000. So the total comes to 9 lakhs. Next is point number 3. Point number 3 is entertainment allowance at rupees 2,500 per month. Next is entertainment allowance. Entertainment allowance is 2,500 per month. So this is coming to 30,000. You can put it in the outer column itself. This is 30,000. Next is point number 4. Conveyance allowance 3,000 per month, and he spends 20,000 for official purposes. So fourth point is conveyance allowance. Conveyance allowance. The amount he is received is 3,000 per month. We'll put it in the inner column. 3,000 per month. So this will be 36,000 minus whatever is spent for official purpose is exempt from taxation, right? Official purpose. He has spent 20,000. So the balance amount of 16,000 is taxable, right? Next point which we are going to see is HRA. Let us just draw these lines. In exams also, I request you to draw these lines so that it is easy for the examiner to correct. Okay, at least in if not in pencil, if it is not, if the time does not allow, at least do it in pen. Okay. Now come here. Start. Just a minute here. Next is point number 5. Point number 5 is in relation to house rent allowance, HRA. House rent allowance. House rent allowance, the total amount which is received is 22,000 per month. So we have received 22,000 per month. So the total comes to 2,64,000. This is the total amount which has been received. Okay. From this, we have to remove the exemption. As per section 10(13)(a). As per section 10(13)(a), least of the following is exempt. Least of these following is exempt. So the first amount is actual HRA received. actual HRA received, which is 2,64,000. I'll write it here itself for sake of convenience. I'll use this column for sake of convenience. 2,64,000. Next is rent paid minus 10% of salary. So for the purpose of HRA, so we'll write it somewhere here. Note. So for the purpose of HRA, the salary will have two components. First one is the basic salary. So what is the basic salary in our case is 6,60,000. And to this, we have to add the part of DA, which is forming part of basic. And this is 50% of whatever is forming part of basic. So that amount is 1,20,000. The total is 2,40,000. Of 2,40,000, 1,20,000 forms part of basic. So that alone has to be included. So the total amount is 7,80,000. So what has to come here is, what is the rent paid first? The rent paid in the present case, if you see the question, is 25,000 per month. So 25,000 into 12, which will come to somewhere around 25,000 into 12 minus 10% of salary. Salary is 7 lakhs. Just now we computed, right? 7,80,000 into 10%. Okay. So the total amount is going to be 000, 12 5 are 60, 0 minus 12 2 are 20, 30. 3 lakhs minus 78,000. So 3 lakhs minus 78,000, this is going to come to 000 2 7 plus 1 8 plus 2 lakhs 22,000, right? So the third point is 50% of salary. So as you know, in case of 4 metropolitan cities, the total salary, from the total salary, 50% of salary has to be computed if the city is a metropolitan city. Only 4 cities are to be treated as metropolitan cities for the purpose of income tax. First one is Chennai, Mumbai, Kolkata, and Delhi. Right? In the present case, it is Chennai. Chennai is a metropolitan city. Since this is a metropolitan city, for the purpose of HRA, we have to take 50% of salary. So our 100% of salary is 7,80,000 into 50%. So this amount we have to compute, and this will come to somewhere around 3,90,000. So least of the following which is exempt is 2,22,000. This amount is exempt. So HRA which is taxable, is 2,64,000 minus 2,22,000, and this amount will come to 42,000. 42,000. Now let us go to the other part. Okay. So for the purpose of either I am removing this just for space constraints. But this the workings note which you will put for HRA and the salary, all those things should form part of your examination's answer paper. Okay. The fourth point which we are going to see after house rent allowance is children's education allowance. For 3 children, he has received, so it is point number 6. Children education allowance. Education allowance. So he has received 500 per month per child for 3 children. So 500 per month per child for 3 children. So he has received somewhere around 18,000. So of this 18,000, exemption is available for 100 per month per child for 2 children. So it is 2,400. This amount is exempt. So the remaining amount of 15,600 is taxable in the present case. Now let us go to point number 7. As far as point number 7 is concerned, medical allowance. In respect of medical allowance, there is no exemption which is available. Medical allowance is fully taxable. Medical allowance, it is fully taxable, and he has received 3,000 per month. 3,000 per month. So this will come to 36,000. Next is point number 8. Point number 8 is Mr. Ratnam contributes to 12% of his salary to RPF, and his employer also contributes the same amount. In case of recognized provident fund, if the contribution exceeds 12%, only this amount is taxable as salary. Okay. In the present case, since it does not exceed 12%, no amount is taxable. This is not taxable. Employer's contribution to RPF, if it is going to be more than 12%, only in such cases it is taxable. And in the present case, since it does not cross the 12% limit, it is not taxable. As far as interest on PF is concerned, up to 9.5%, it is not taxable. Up to 9.5%, this is not taxable. And in excess of 9.5%, any interest which is received, this interest alone is taxable. So only up to 9.5%, this is not taxable. Interest on PF up to 9.5% is not taxable, and more than 9.5% is taxable, right? So interest on PF. Interest on recognized provident fund. So it is, so he has received total of 36,000. So if this is for 12, 9, so 9.5, the remaining 10.5, 11.5, and it is 12. So 2.5, it is taxable. Okay. So the total amount in this case is going to be 12. It is going to be somewhere around 7,500. Okay. Now let us go to the next point. He is provided with a self-driven car of 1200 cc, which he uses for both official and private purpose. Car is owned by the employer, and all the expenses are borne by the employer. In case of a car which is having a cc of less than 1600 cc, it is owned and maintained by the employer, means 1800 per month is taxable value of perquisite. Now in this case, car perquisite, it is 1800 per month. So this total amount is going to be somewhere around 21,600. 21,600. So the total amount, there is one more point. Next is professional tax. This is paid by the employer. This is an expense of the employee which is paid by the employer. Hence, since this is paid by the employer, this is taxable in the hands of the employee. Professional tax. It is 200 per month. 200 per month. So this is 2400. So if you do the total, this will come to somewhere around, just give me a minute, let me put the total. Let us put this total. It is 9 lakhs plus 30,000 plus 16,000 plus 42,000 plus 15,600, 15,600 plus 36,000 plus 7,500, 7,500 plus 21,600 plus 2,400. So if you see the total, it comes to, there is one mistake, I guess. 9 lakhs plus 30,000. Just give me a minute. 9 lakhs plus 30,000 plus 1 lakh 60,000, 16,000, 1 lakh 60,000, 42,000, 15,600. Next is 36,000. Next is 7,500. Next is 21,600. Then 2,400. So the total, again, there is one mistake here. 1 lakh 60,000, 16,000. So the total comes to 10 lakhs 71,100. So this total comes to 10 lakhs 71,100. So from this, we have to make two deductions. First one is standard deduction. Standard deduction in case of old scheme, it is 50,000 only, and it is not 75,000. Remember this. In case of old scheme, the standard deduction is only 50,000 and this is not 75,000. Next deduction is professional tax. 2,400, whatever is paid is allowed as deduction. So the total amount in this case, it is going to come to around 10 lakhs 18,700. This is the total income from salary. Total income from the head salary. Okay. Now let us go to the question number 6. With this salaries chapter is over, we have solved two questions. One question in the old scheme and the other question in the new scheme. Now let us go to the next chapter. Now let us focus on income from house property. Income from house property. As far as income from house property is concerned, it is a very, very easy chapter and a very good scoring chapter. And generally, the format, I generally don't teach or go by format, but considering this is last minute revision series, I thought this will be helpful at this stage. So the format for arriving at the total income under the head income from house property will be, first you have to compute your annual value of the property. First you have to compute annual value of the property. Annual value of the property. And from the annual value of the property, you have to subtract the municipal taxes. Municipal taxes. So from the annual value of the property, you have to subtract municipal taxes, and this is going to give you net and gross annual value. sorry, I'll just use the terminology which is used by books. This will be gross annual value and this will be net annual value. This will be gross annual value, gross annual value. This will be net annual value. So from this net annual value, there are only two deductions. Deduction under section 24A, which is going to be 30% of net annual value. Net annual value. And the next deduction under section 24 is going to be interest. Interest on capital for construction. So this is going to be the next deduction. So after this, you will get the income from house property. Only two deductions are there. This is a very small chapter, only two deductions, right? So some points to ponder in this chapter is, some points to remember. First point is total deduction under 24B in case of a self-occupied property. Self-occupied property should not exceed 2 lakhs. Your total deduction under section 24B in respect of a self-occupied property should not exceed 2 lakhs. That is the first point. Second point is municipal taxes is not allowed as a deduction in case of a self-occupied property, right? Third point is if part of the house is let out, and part of the house is self-occupied, then in that case, all computations like municipal value, standard rent, fair rent, everything should be proportionate. Everything should be proportionate. And one more point is how to compute your gross annual value. So gross annual value computation will be, first one is fair value or so in this case, first we have to compute what is the gross annual value. The computation of gross annual value is going to be municipal valuation or fair rent. Municipal value or fair value. This will be your step 1. This is step 1. Municipal valuation or fair rent, whichever is higher. So from this, whichever is higher, it will come as answer in step 1. Okay. So third point is step 1 or standard rent. Standard rent. So of these two, whichever is lower will be your step 2. Fair value, municipal valuation or fair value, whichever is higher, which the answer will be step 1. Step 1 or standard rent, whichever is lower, that is going to be step 2. Okay. Now from this step 2, you have to compute actual rent. Actual rent. And of these two also, whatever is higher is taxable. Of these two also, whatever is higher is taxable. However, this is step 3. However, if step 3 is greater than, if step 3 is lower than step 2, and this is fully attributable, and if this is fully attributable to vacancy, in this case alone, the answer in step 3 should be taken and not answer in step 2. This is the only point. This is known as vacancy allowance. If your step 3 is lesser than step 2, And if this difference is fully attributable to vacancy, in such case alone, the actual rent, that is step 3, should be taken and not step 2. In all the other cases, step 2 alone should be taken as the value, right? Now let us get into the question. And one more point is, you can have 2 houses as self-occupied properties. 2 houses shall be treated as self-occupied property, self-occupied property. And one more point is, in case of unrealized rent, if it is in the year in which it is realized, you can tax it. 30% alone is allowed as deduction. No other deduction is allowed. So in respect of unrealized rent, 70% is taxable. Okay. This is a short summary of this chapter. Now let us get into the question. Question number 6. Mr. Thakur is the owner of 3 houses. From the following particulars of the houses, compute his income from house property for assessment year 25-26, assuming that he has opted for the old regime of taxation. So in relation to his income from house property, the difference between old regime and new tax regime is, in the old tax regime, the interest deduction is allowed. 24B deduction is allowed only in case of old tax regime, and this is not available in new tax regime. This is the only difference between old tax regime and new tax regime. Okay. Now let us get into the question. So the first house is situated in Delhi. It was let out with effect from 1/4/2023 for 20,000 per month. This was vacated by the tenant on 31/1/2025, and this remained vacant for 2 months. The municipal valuation of the house is 2 lakhs. Municipal taxes are paid at 18% of the municipal value. Fair rent and standard rent of the house are 2,20,000 and 2 lakhs respectively. Interest paid by him on money borrowed for the purchase of house was 60,000. The construction of house was completed on 31/12/2018. In the previous year 24-25, rupees 15,000 has been recovered for unrealized rent relating to previous year 2021. In second house, the house is situated in Kolkata, and this has been transferred to his wife in 1997 without any consideration. Since this is without any consideration and this is transferred to his wife, the owner, the transferor, is deemed to be the owner of the property, deemed owner, under section 27(1). Under section 27(1), Mr. Thakur is treated as the deemed owner. In this case, Mr. Thakur is deemed as the owner because the property is transferred without consideration to his spouse. This is applicable only to spouse or children. Since the house is transferred to his spouse without any consideration, the transferor is deemed to be the owner of the property. Okay. The municipal value of the house is rupees 5 lakh. He, however, uses this house for his own residence. The municipal tax paid to the house was 18,750. He took a loan for the purpose of repairing the house. The loan amount is still outstanding. The loan, the interest on loan due for previous year 24-25 was 1,65,000. Of which he has paid 1,45,000 during the previous year. In this case, first we have to note that only he has borrowed it for the purpose of repair. So since he has borrowed it for the purpose of repair, the interest deduction is limited to the extent of rupees 30,000. The interest is limited to the extent of rupees 30,000. Okay. However, what you have to notice, only in case of municipal taxes, whatever is paid is allowed as deduction. In case of municipal taxes, whatever is paid alone is allowed as deduction. In case of interest, whatever is accrued for that period, that is allowed, and there is no embargo on payment. There is no embargo on payment in section 24B. Okay. Now let us go to the third point. The house consists of 2 identical flats situated in Kolkata. One flat has been used by him for his own business, and the other has been let out to a tenant. He received rupees 30,000 as rent from the house. The net municipal value of the house is 1 lakh, and he has paid 9% of municipal tax. He has paid municipal tax at 9%. Right. With this, the question ends. Now let us compute income from house property for Mr. Thakur. Now let us get into the computation. Question number 6. Computation of income from house property of Mr. Thakur. So first it is going to be serial number as always. The next is particulars, then note number, amount. Note number, and there are 2 amount columns. Okay. So now there are going to be 2 amount columns. Serial number, particulars. This is how you have to present your answer. Particulars. Actually, in a very legible manner, not like this. Right. The format is this, but due to some other constraints, my handwriting is a bit not legible. Okay. Amount entries. So first one is in relation to house number 1. House number 1 is situated in Delhi. Correct. House number 1. House 1 let out Delhi. First, we have to find the gross annual value. So for that, first we have to find the valuation, gross annual value valuation. So first one, it is going to be municipal valuation. Municipal value. What is the municipal value here? Municipal value is 2 lakhs. 2 lakhs. Or fair rent. Municipal value or fair rent. The fair rent in the present case is 2,20,000. So municipal value or fair rent, whichever is higher. This should come in step number 1. Step 1 is going to be higher of municipal value and fair rent. So hence this is 2,20,000. Next point is step 1 or standard rent, whichever is lower. In the present case, standard rent is 2 lakhs. Okay. Hence, whichever is lower. Step 2 is lower of step 1 and standard rent. This is 2 lakhs. Then the next point is actual rent. Actual rent in the present case is 20,000 for 10 months. 20,000 for 10 months. This is 2 lakhs. So the total amount of gross annual value for house number 1 is 2 lakhs. So of this 2 lakhs, first we have to reduce the municipal taxation. Municipal tax. So municipal tax in the present cases, he has paid 18% of municipal value as taxation, right? So in the present case, the municipal value valuation is 2 lakhs into 18%, which is 36,000. This is 36,000. Okay. Now gross annual value minus municipal tax is going to give you the net annual value. Net annual value. So this net annual value, it is 1,64,000. So from this you have to reduce deductions. In this deductions, the first deduction is going to be standard deduction. Standard deduction is going to be 1,64,000 into 30%, which is 49,200. 49,200. Next is interest. So if you see the interest is 60,000. Interest is 60,000. So total income from house property 1 is going to be total income from house property 1. This is going to be 54,800. This is your total income from house property 1. Okay. Next is house property 2. House property 2, and this is self-occupied. As far as self-occupied property is concerned, we have already seen net annual value itself is nil. Okay. So from this net annual value, only interest deduction under 24B is eligible. Interest under section 24B. So whatever is interest has been paid, that alone is to be taken. And in this case, since it is for the purpose of repair, only 30,000 is eligible. Okay. So this 30,000 loss alone is eligible. 30,000. Then loss from HP2. Loss from house property 2. This is 30,000. There is no other deduction. 30,000. Next, let us go to house property 3. House property 3. As far as house property 3 is concerned, there are 2 identical flats which is situated in Kolkata. So first is house property 3, unit 1. Unit 1, it is used by him for his own business. So there is no amount which is taxable. Unit 1, there is no taxation. Next is house property 3, unit 2. House property 3, unit 2. In this case, he has received 30,000 as rent. Municipal valuation is 1 lakh. So 1 lakh into 50%, this is going to be 50,000. Right. So again, municipal valuation or fair rent, whichever is higher, we don't have fair rent and standard rent, no other comparison. Whatever is higher between the municipal valuation and rent received, that has to be treated. In this case, municipal value, the gross annual value is going to be 50,000, which is 50% of 1 lakh. 50,000. Okay. So from this, we have to reduce the municipal taxes. Municipal taxes is 9%. So 1 lakh into 9% into 1 by 2, because half of it is used by him for his own purposes. So we have to reduce 4,500. So if 4,500 is reduced, my net annual value is going to be 45,500. So of this 45,500, you have to reduce the standard deduction under section 24A. 24A, this is going to be 30%, which is 13,650. So the total income from house property of third unit, income from house property of third unit is going to be 31,850. Now let us add all the three. So HP1 plus HP2 plus 3, HP1 plus HP2 plus HP3. So if you see, the total comes to 67,150. So this 30,000 and 31,850, this is 1,850. Then we have to add this 1,850 to 54,800. This is 67,150. Now to this, we have to add the unrealized rent portion. We have to add the unrealized, sorry, there is a small error here. This is the final, this is not the total. And to this, you have to add the unrealized rent portion. So as far as unrealized rent is concerned, he has received 15,000 as unrealized. 15,000 is received as unrealized rent. Of this, 1/3 is 30% is not taxable, that is allowed as deduction. So only 70% is now is to be taxed, which will come to 10,500. Now the total comes to 67,150, and this is total income from house property. Total income from house property. With this, the question ends. Okay. So without forgetting, remember to include this part of unrealized rent. If you have some doubts in this, what I would suggest is, while you're doing the first house itself, complete this part also, so that it is not omitted. Okay. Now let us go to question number 7. Question number 7 is other question in relation to house property itself. Right. In this case, Arun is the owner of 2 houses in Chennai. From the following particulars, compute his income from house property for assessment year 25-26, assuming he has opted for the old tax regime. House number 1 was purchased in previous year 11-12, and it has 2 independent units. Unit 1, 50% of floor area is let out for residential purpose. Rent received is 1 lakh. Unit 1 remains vacant for 2 months when it is not put to any use. Unit 1 remains vacant for 2 months when it is not put to any use. Unit 2 is utilized for his own residence. Other particulars of the house are as follows. Fair rent is 2,48,000. Municipal valuation is 2 lakhs. Standard rent is 2,28,000. Municipal taxes paid is 20,000. Repairs is 10,000. Interest on capital borrowed to purchase the property is 1,20,000. And fire insurance premium is 40,000. In respect of house number 2, Arun is using this house for the purpose of his residence since 2022. In this case, he has took a loan of rupees 12 lakh at 10% for construction of this house. On 1/4/2019, and the construction was completed on 1/6/2022. He repaid the amount of loan to the extent of rupees 2 lakhs, and on 30/6/2024, but no interest was paid during the year 24-25. So we have already seen this payment is not a criteria. Okay. The municipal value of the house is rupees 3 lakhs, and he has paid 10,000 as municipal tax and 5,000 as repairs for the home. Now what we have to do is we have to compute the income from house property. So now let us solve question number 7. Right. Computation of income from house property. For assessment year. In this case, the assessment here which is involved in the present case is 25-26 as. So first one is serial number, particulars, Note amount. Okay. So in respect of house number 1, unit 1. So first we have to find out the gross annual value. So unit 1 is let out for residential purpose. Right. So first we have to find out the gross annual value. So for that we have to take the municipal valuation. Municipal valuation of the house is 2 lakhs. But since it is half of, we have to take only half. So municipal valuation is 1 lakh. Then fair rent. Fair rent is again 1 lakh. Fair rent, if you see here, 2,48,000. We have to take only half of it. So it is 1,24,000. So step 1 is higher of municipal valuation or fair rent. So this is going to be 1,24,000. Then second part is standard rent. Standard rent is 2,28,000. So here it is going to be 1,14,000. So step 3 is going to be lower of step 1 or standard rent. So here it is 1,14,000. Okay. So next is actual rent. Actual rent is 1 lakh rupees. Generally, what should happen is this higher of step 3 and actual rent should only be considered as the gross annual value. However, in the present case, if you see, the rent which is received is 1 lakh. If it is let out for the whole period, that is for 12 months, this would have been 1,20,000. This would have been 1,20,000. If this had been 1,20,000, then the actual rent will be taken as the gross annual value. In this case, actual rent is lesser than step 3 because of vacancy. It is because of vacancy. Hence, this 1 lakh is to be treated as the gross annual value. Sorry, 1 lakh. So from this 1 lakh, you have to reduce the municipal taxes which is paid. Municipal taxes which is paid in the present case is 20,000. Of this 20,000, 10,000 pertains here. Right? So 10,000. Your net annual value in the present case, net annual value in the present case is 90,000. So from this 90,000, you have to reduce standard deduction. At 30%, which is going to be 27,000. And interest under 24B is also to be treated as deduction. Interest. And interest in the present cases, the total interest is 1,20,000 for the entire house. So for unit 1 alone, this is 60,000. So if you remove the total answer in respect of unit 1 is going to be 3,000. So income from house property, house 1, unit 1 is rupees 3,000. Okay. Now let us go to house 1, unit 2. House 1, unit 2. In respect of house 1, unit 2, this is a self-occupied property. This is a self-occupied property. In respect of a self-occupied property, the net annual value is nil. Okay. So only interest is to be allowed as deduction. In this case, interest, this is 60,000 again. Now let us go to, just wait for a minute, because in this question, if you see, totally there are 2 properties which is let out. So first one is house 1, unit 2, and the second one is house 2. right? And we have already seen the entire cap itself for a let out, in case of a self-occupied property, the interest on borrowed capital, the entire cap is rupees 2 lakhs. So in this case, this is going to be 60,000 of loan. Okay. Just remember, this is due to interest only. Now let us go to house 2. House 2 is again a self-occupied property. House 2 is again a self-occupied property. As far as house 2 is concerned, if you see here, the loan was taken for 1,20,000 at 10% per annum from 1/4/2019, and the construction was completed on 1/6/2022. So this portion gives us a hint that there is pre-construction interest. Pre-construction interest. As far as pre-construction interest is concerned, from the period in which the loan is borrowed till the year, like I'll put it this way rather, till the end of the financial year, preceding the financial year in which the construction is completed, from the date of loan till the last date of the financial year, preceding the financial year in which the construction is completed, the interest for this period is to be split out into 5 parts. Is to be split out into 5 parts, and it has to be claimed equally in 5 parts. Equally in 5 next subsequent years. So assume, for example, if a construction is completed on 1/6/22, then what will happen is, and the loan is taken on 1920. So for 1920, 2021, 21/22. So for these 3 periods put together, this is known as pre-construction interest. Right. So for the period from 1/4/22 to 1/6/22, even though this period is also pre-construction period, this interest will not form part of pre-construction interest, because for an interest to form part of pre-construction interest, the completion should not have happened during that year. Okay. So if on any date for that matter, if the construction is completed, the interest which is paid for that period, so assume for example from 1/4 to 31/3, if on any date between these 2 dates construction is completed, you have to assume that in the present year there is no pre-construction interest, and the entire interest, whatever is incurred during this period, is to be allowed in the same year in which construction is completed. So for this 1/4/22 to 1/6/22 also, the deduction would have been availed in 21/22 itself. So this period from 1/4/22 to 1/6/22, this should not be considered as pre-construction interest. So only for 1920, 2021, and 2022, only for these 3 periods you have to take the. So now if you see pre-construction interest, so it is there for 3 years. So 1 year, if you see, the total interest value is 1,20,000 into 10%. This will 12 lakhs into 10%. This is going to be 1,20,000. So 3,60,000 is the total pre-construction interest which is to be distributed. So per annum distribution, which is attributable to assessment year 25-26, is 1/5 of this, which will come to 72,000. Right. Next is post-construction interest, that is for the current year interest. In the current year, totally there are 2 components. The first one is pertaining to, there is a payment which is made during the current period. So the total loan amount is 12 lakhs. Of this 12 lakhs, 2 lakhs they are paying it on 36/20/24. So for 3 months period, that is April, May, and June, the outstanding loan is 12 lakhs. Outstanding loan is 12 lakhs, and the rate of interest is 10% for 3 months. This comes to somewhere around 30,000. Okay. Now for the remaining period, 12 lakhs into 10 by 100 into 9 by 12. This comes to 75,000. So the total interest, whatever is applicable for this period, is 1,77,000. But if you see, if you are going to add this 1,77,000 to the 60,000, your total deduction under section 24B for a self-occupied property is going to be more than 2 lakhs. Hence, this amount should be restricted to 2 lakhs. The interest amount is to be restricted to 2 lakhs. Right. So our profit here is 3,000. In respect of house property 1, the profit is 3,000. And loss in respect of 2 house properties is 2 lakhs. So 2 lakhs minus 3,000. So it is going to be 1 lakhs of 97,000 loss. Right. This is in relation to question number 7. Next, let us go to question number 8. Question number 8 is a simple question which is going to deal with whether an expense is allowable or not in respect of PGPP. Now we are shifting from house property chapters to PGPP chapter, right? So in this video, we'll just look at one simple question alone in relation to PGPP. The other things in relation to PGPP, we'll look at that in the next question, right? So this is a simple question we'll solve here itself, right? So, but for each of this, you have to give detailed reasoning. I'll just say whether this is allowed or not. So in this case, first point is whether interest on funds which is borrowed for paying income tax, is it allowable as an expenditure? This is not a business expenditure. There are multiple case laws at this point, but consider this being an inter examination. I'm not getting deep into the case law, right? Second is legal charges were paid for registration of trademark. This is an allowable expenditure. Legal expenses including lawyers fees for raising a loan from financial institution. This is a allowed expenditure. Lump sum paid to an employee in respect of regular pension. This is an allowed expenditure. Ex gratia payment. Again, this is the allowed expenditure. Now let us come to bad debts. As far as bad debts are concerned, so what will happen? Whether or not there is a bad debt, if this is accounted as bad debt in the books of accounts, if it is accounted as bad debts in the books of accounts, then whether or not this is a bad debt, this is a allowable expenditure. If bad debt has been incurred and whether or not that is an actual bad debt. So assume, for example, you have total of 1,000 crores as creditors. Okay. So of this, you say 50 crores is bad debt. You have written this off in your books of account. So this 50 crore, you are writing it off. So once you're writing off this 50 crores, whether or not this 50 crore is receivable or not, if you are going to write it off from your books of accounts, that is bad debts. You are not required to prove whether it is a bad debt or not. That applies to reverse also. If a debt is to be treated as bad, the person is set as insolvent. But if such debt is not written down in your books of accounts as bad debts, then that shall not be allowed as deduction. If a bad debt is not allowed in the books of accounts, if a bad debt is not allowed, it's not treated as expense in the books of accounts, then in such case, this is not a allowable expenditure. So now in the present case, 70,000 is considered as bad. The debtors were declared insolvent having no assets. The amount was, however, not written off as irrecoverable. This is still not written off as irrecoverable. Hence, this is this expense is not allowed. Okay. Next is compensation of rupees 10,000 paid to party for non-delivery in terms of contract. This is an allowed expenditure. Rupees 25,000 paid to creditor. This is again a not allowed as per 40A3, since this is more than the 10,000. If it is more than 10,000, then it is not allowed as an expenditure. Next is interest on capital for proprietor. The concept of interest on capital for proprietor itself is not there. Okay, that is applicable only for partners, and that is also, it is to be provided by the partnership deed. In case of sole proprietorship firm, this is not allowed as a business, right? So with this, we'll conclude this short video. In the next video, we'll solve bigger questions of PGBP, right? So some three important questions. So three different types of questions, rather not important. Three different types of questions. One wherein we'll deal with the starting from net profit. One will do it from receipts and payment account. One will do it in case of a firm. Right? So we'll do it this way. So these are the next three questions which are going to solve in relation to PGBP. That will be in the following video. So whatever doubts you have, you can just put it in the comment box. We'll resolve it at the earliest, or other just give your feedbacks in the comment box. We'll definitely go through this. If you want the PDF copy of this, if you want a PDF copy of this, just text to this number to get the PDF copy of the Super 30 question. Right? Thank you. Bye.